Hi, welcome back to the Corporate Finance Academy. Today we're going to go through price volume mix analysis. So what we're going to talk about is this is really variance analysis, and we want to know if our sales and our profit are moving from pricing, volume, the mix of our products, or cost. We're going to show you how it's actually calculated, and we're going to go through in Excel. Okay, so price, volume, and mix. So this is really a good way to try to understand your company and how your sales or revenue and your profit looks in two different time periods. So whether it be this year versus prior year or versus a budget. So you've got a few different elements here. The first is price. So what is the impact and a change of your net sales price? Volume. How many units you're selling, and are you selling more or less? Mix, most companies have more than one product, and this is going through the ratio of the products that are being sold. So if you sell more of a high margin product or more of a low margin product, that'll swing you. And then cost. And cost only applies to the profit piece of the price volume mix walk. And this is a change in your unit cost. So why do we care? If you work in finance, corporate finance, you'll almost certainly have to analyze changes versus a period or actuals versus a budget. This walk can tell you a story about what's going on in the business versus just looking at simple changes in year over year or versus budget. This gives you an extra level of granularity to start really understanding what's going on. And it's going to tell you where to dig deeper. So maybe it's a product mix issue, maybe you increase price and your units dropped. You're going to learn more. And likely as you go through these things, you're working with an operations team to try to understand what's happening from a product or operational standpoint. And this is going to help direct you with where you want to go dig and work with the ops team, not just asking them blanket questions, but asking them intelligent questions to try to understand what's really happening. So what do we need to do? You have a sales variance. Your change in sales versus a prior year versus budget, you have price and you have volume. So the price is simple, it's what your price is, and then volume has two components. It has the number of units that you sold, the quantity that you sold, and it has the mix of which products you're selling. And then you have a profit variance. So profit is really the same as sales, except you add in the cost element. So price. How much of the change in sales from last year to this year is related to the price that you actually charge your customer? Companies often try to improve profitability by increasing the price each year or maybe even more frequently. This combats inflation that you see from your suppliers, whether it's raw materials or otherwise, and then wage inflation. Most companies give employees increase, whether it's for inflation or cost of living or whatnot, but salaries and benefit costs go up every year for a company. And if they're not increasing price, then their margins will go down. So an example, if Snickers charged $1 for a candy bar last year, they might charge $1.05 this year. The key in this whole calculation is isolating the impact to only the change in price or whichever area you're looking at. So how do you do that? You take the price per unit in this year minus the price per unit last year, and you take the difference between those two times your current year units. So you calculate the change in price for each product versus the prior year. If you charge a consistent price for each product, you already have that price per unit. But more than likely, you're going to have to take your net sales divided by your units sold to get to that price per unit. Now your next step is going to be to calculate the impact of the change in price between periods. So you take the variance, your price variance from step 1 times the current year units sold. So this will give you the sales impact, and there's no additional step needed to calculate the profit impact, since any dollar you increase the price change should fall directly through to profit. Now remember, costs might be going up, but if you're trying to isolate price as a variable, you need to ignore cost. So when you calculate price, your sales and your profit impact will be the same. So here's a quick example. You've got $100 price per unit prior year, $110 current year. Cost is flat at $50. Your profit per unit goes from $50 to $60. So sales are up $10 and profit is also up $10. Now we'll skip right to an example in Excel. Okay, so looking in Excel here, we've got 2018 actuals, 2019 actuals. This is just data. So these are what you would assume are your real unit sales, cost of goods sold, profit, and profit percent. So to get price, we start here and we say we don't have price per unit, so we have to calculate it. Very simple calculation. It's net sales divided by units, and we're doing that same thing for 18, 19, and for product A and product B. So what do we learn? We learn that the change in price on product A is up $2, and product B is flat. So we've got a total of a $2 change in price, and now we have to multiply that by this year's units. So we're selling 2 units this year. So the $2 change in price times the 2 units we sell should give us a $4 impact to our sales. And like we talked about, profit, all of this price should fall right through to the bottom line, so you've got a $4 profit as well. This stuff is definitely tricky, so if you have questions, leave them in the comments, or if you need additional explanation, feel free to leave those in the comments as well, and we'll do our best to help explain. So moving on to mix. Mix, we're looking for how much of the change in sales and profit is related to the mix of products we sold. So if you think about a lot of companies, they have multiple products. BMW sells a 3 Series, they sell a 7 Series. If you assume that the 7 Series is sold for a much higher price and profit, if they sell more as a percentage of the total 7 Series, it's going to drive an increase in sales and profit. And really, it's kind of a part of the overall volume, but we'll get to that. So getting to the formula, there's a bunch of stuff at the top. It's important to understand it. But diving into step 1, as you read across the formula, starting here, current year units, that's a known item, so you can skip to this second piece, which is right here. The prior year product price per unit minus the prior year total price per unit. So you've got the price per units here, and then to calculate a blended here, which is really just, again, a blended between the two. So this is really looking at whether this product is bigger or smaller than the average total price per unit. So product A is larger than the total price per unit. It's $25 versus the $14.30 average. And product B is smaller, so $10 versus the $14.30 average. So now you move to step 2, which is this part of the equation. The current year product percent of total units minus the prior year product percent of total units. So you can see the number of units you have up here. And what you're trying to understand here is the product getting bigger or smaller in proportion to the total? So product A is 4 out of 14 units, so 29% of the total. And product B is 10 out of 14 units, so 71% of the total. You then have a current year product percent of total units, and you have the prior year product percent of total units. Now you have to put these pieces together in the formula and calculate, and this gives you the sales variance. Now to get to the profit variance, you have to take that sales variance and multiply it by the prior year's profit margin rate. because remember, you're calculating sales. Now you have to get that down to a profit rate. So you can see here, you've got 29% going to 12% for product A. It's down 17% total volume, whereas product B is up 17%. And now let's walk through that in Excel. Okay, so back to our Excel here. We're going to start by getting the percent of volume out of the total. So simple math, 4 units out of 14 total is 29% of the total, whereas 10 out of 14 is 71. Do the same thing for 2019, and you find that product A is going down 17% as a percentage of the total, and product B is going up 17. Sales, we're going to use the formula that we had on this sheet, which again I recommend going step by step to really understand what the formula is doing. But we're going to plug and play that formula, and what you get is product A is causing a $30 million drop in sales, whereas product B's mix is causing 12. So in total, the product mix is actually causing you $43 million pressure, which is really interesting. But then if you think about it, you see that product A you sell for much higher than product B and much higher than the total. And product A is going down. So the product that we get a lot more for each unit, we're selling fewer of, so that's going to be a drag. And the product that we get much less money for is going up, so that's similarly bad for us. So you've got a $43 million drag to your sales. And now to get to profit, as we mentioned, we're going to multiply by last year's profit rate. So you got a $43 million drag to sales and a $24 million drag to profit. Okay, so moving on to volume. So how much of the change in sales and profit from last year is related to the number of units sold? So assuming price and cost are constant, the understanding what the volume change means is pretty straightforward. So if a company had $100, they charged $100 last year, sold 5 units, they charge that same 100 this year and sold 10, they would make an additional 500 based on volume. So part of volume is due to selling more units, but also if a company has more than one product, the impact can also be due to the mix dynamic that we just went through. So keep that in mind. That'll be the last step of this calculation. So step 1, calculate the change in units, taking current year less prior year. So very simple, straightforward calculation. Then you take that change in units that you see here, multiplied by prior year price. And we use prior year because we want to do this calculation as if volume is the only thing that has changed. And if you used current year price, you're mixing in the year-over-year change in price. Step 3, remove the effect of mix. So just like we said in the prior step, we calculated mix. We need to back that out of this formula since mix is really a subset of volume. Next, you have to put the pieces together and calculate it. So the result you'll get is the sales variance, but then similar to what we saw on mix, you have to then calculate the profit variance. To do that, you take the sales variance and you multiply it by prior year profit rate. So let's jump into the Excel. Okay, so volume impact, just like we talked about, you've got your units in 18, units in 19. So what's the change year over year? Here's your change. Now to get to the volume impact, you're simply going to take your change in units times the number of units, and then like we said, we're going to back out mix. So the volume impact, you're down $19 million from product A, but you're up $62 million on product B volume for a total of up $43 million. And then when you multiply these times last year's profit rates, you get down 11, up 28 for a total of plus $16 million. Now we move on to cost. In cost, we're trying to find out how much of the change in profit, remember cost only applies to profit, is related to the cost per unit sold. Change in cost has no impact on sales, it's just an explanation for profit. And cost changes as a result of better or worse pricing with suppliers, or maybe a business's efficiency in providing their product or service, or a number of other things. And a quick example is if a company charged $100 per unit last year and sold 5 units, then this year they also sold 5 units each, but their cost dropped from $50 per unit to $40. They're going to make $50 more than they made last year because $10 per unit and 5 additional units. So the formula is cost per unit current year minus prior year cost per unit times current year units. It's pretty straightforward. Again, you may have to do math to take your cost of goods sold divided by your units sold for each product. So that would be your first step. And step 2 would be to calculate the impact of the change in cost between the periods. So you take the year-over-year cost per unit variance that you calculated here and multiply it by current year units sold. Again, this will impact profit only. So let's jump to the Excel for this one. Okay, so to get the cost impact, we're going to take our 18 costs per unit versus our 19 costs per unit. You see the change. Here you've got no change in product A, 0.5 change in product B. And then you take, as we said, there's no impact on sales for cost, but there is on profit. So to get the profit impact, you're going to take your units times your change in cost, and that's going to be your impact. So here we've got no change in product A. Product B, we've got 0.5 across 15 units, which gives you a 7.5 profit impact. So the last thing we want to touch on is a summary and walk the sales and profit from one year to the next. So to see how this actually plays out, you want to walk it across. So you've got product A here, which if we look, we had, and again, we're looking at sales first, we had 100, and that's just an actual. Same with product B, and then you've got your 19 actuals. So all we're doing is taking those and we're saying we went from 100 to 54 of sales and from 100 to 150 of sales. And here's the walk that goes to tell you that story. So using our discrete buckets that we looked at, you've got your price, which is 4. You get your mix, which is 31. You've got your volume, which was 19. And you've got nothing for cost, and it walks across to 54. And what you see over here is just a quick check to say, okay, if I take these elements, do I actually add up to the 54 I would expect to get to? And in this case, you do. And same at the total level. And then the same thing for profit. So product A went from 60 of profit to 34, and here are the drivers as to why. So when you look at this, you'd probably start to analyze this and say, look, volume's great on product B across the board. Why is that? Are we pricing it wrong? And product A is down. Are we pricing these wrong in relation to each other? Are our marketing efforts out of proportion that we're pushing the wrong product? Because ultimately what's coming is we're selling more of the product that we make less money on, and we're selling less of the product that we make more money on. And then you'd want to go dig into that to understand it better. So variance analysis in this price volume mix analysis, as you go through it, you really want to take the time to understand each step and how the formula works and why the math is what it is. It can be a little confusing if you just look at the total formula and how you calculate it. But as you understand each step, it helps you get through. And this will really help you better understand the results, and it'll let you know if something isn't right. Depending on what level of granularity you do the analysis at, you're going to get a different result. So in our simple example, we have product A, product B. But if you looked at Toyota as an example company, they might do this analysis by their core models, which would be like the Corolla, the Camry, the Highlander. Or they might do it at a submodel level, where you have a Highlander, a Toyota Highlander that comes as a base model, and then you have a premium model. And they could all have different levels of profitability. And you're going to get different results based on the cut of data you choose to do. Or potentially you might not do it at a product level. You might do it at a region level, for instance. So you might do Asia, North America, South America, Europe, and you'd get different results there as well. And the last point, and we've touched on this, a good finance analyst, finance manager, CFO, the numbers don't tell the whole story. So you need to work closely with the operating team to really understand what's going on, what's driving this operationally, the numbers are really a tool to drive that discussion. And there's always some shortfalls. So no one piece of analysis tells you everything. You have to combine this with other analysis, understand at a more macro level what's going on, talk to the operational team, as we said. Okay, that's all we have. So please subscribe, like or dislike, leave questions and comments. This can be complicated. You might find other people who take a different approach. We can also make this Excel template available to anyone who wants it. So leave comments, leave questions, and we'll see you again soon.